Hi, this is JR. It's just after 5 a.m. Pacific time on the 9th of August. The 9th of August, 2011. This is called First Harmony, then Prosperity, or Harmony internally, then Prosperity externally. Yes, there is more to life than money. Also important, a fool and his money are soon parted. So be aware of the possibility of being foolish about wealth. Be aware of the possibility of being foolish about all of life or any of it. Then be aware of the possibility of being calm and clear and courageous about life, including the aspect of life regarding wealth. Lately, many people are talking about financial risk and the results that they have called surprising. Many of them have been investing their trust in mass media or massive bureaucracies like the insurance company AIG, or the Federal Reserve, or the government of the USSR. You thought I was going to say US, didn't you? What have been the consequences of investing trust in the mass media and massive bureaucracies? Have those results, perhaps as being unpleasantly surprised, raised the question as to whether those methods might have been foolish? Is it possible that foolish methods of investing trust may produce the result of financial losses, kind of like gambling, or rather like the saying goes that a fool and his money are soon parted? What about discounting the importance of financial realities? Are finances suddenly important to you, like since yesterday's announcement of U.S. Treasury debt being downgraded? Or were they always important and only recently recognized as important? How about this? Are gasoline or electricity suddenly important to you? Or were they always important and only recently recognized as so important because we could take them for granted until prices had reached a point that we altered our perspective and our behavior based on things like rising gasoline prices? There's a picture of some prices of gas over $4 a gallon. That's from 2008. For many years, I have been focusing on the possibility of rising fuel prices and their consequences on the economies of Japan, the USSR, Europe, and the US. My publication in 2004 of The Real U.S. Deficit Oil featured a section called The Domino Oil Effect, relating to why I expected fuel prices to continue their dramatic rise that began in 1999, and what consequences I expected in the U.S., which I expected to be similar to what had been happening in Japan since 1989 and the UK and EU since 1999. The next chart shows the all-time low of inflation-adjusted prices of gasoline in the U.S. in 1999. That's the red line of the chart there. Global oil prices also made a major low in 1999, $11 a barrel. Next picture is the Japanese stock market, still down about 80% after 21 years of recession. How long are recessions? And then the last chart is that of a stock market called FTSE, the stock market of the UK. Next here is what gas prices in the US were near the time of that article in 2004, about in the middle, right halfway or so between $1 and $2 a gallon. In that article from 2004, which I have a link to below, I focused on a single question and the implications of that question on the U.S. economy and prices in the U.S., prices of stocks, prices of real estate, prices of most anything. How many dollars will it cost to buy a gallon of gasoline next year? So that was my central question in that article link there. Here's an 8-year chart of what happened starting in 2003. We can see, about $1.50 gas prices there throughout most of 2004. And then they rose, and then they kept rising, and into middle of 2008, that's prices of unleaded gasoline, I believe, in Los Angeles. And there's a link to where I got that chart from. Some people have questioned my logic because of oil and gasoline prices falling sharply in 2008. However, for those that have the courage to read my old articles, I did not say that demand for fuel would never drop, or that prices for fuel would never drop. On the contrary, I simply said that diminishing supplies, since the easily predictable peaking of global oil production in 2006, diminishing supplies of fuel would raise prices enough to slow down the global economy. That's the domino effect. The prices would go up of oil and fuel, and then that would knock down the next dominoes. So as prices of fuel rose, that would slow down the global economy, including the economy of the U.S. That predictable slowing of economic activity would predictably reduce demand for fuel, which would predictably drop prices for fuel and other things too. But the drop in 2008 of fuel does not disprove the accuracy of the logic, but establish it. I may have even published all that content. I'd have to look over the articles from 04 and 05 and so on, but it's pretty easy to see the logic oneself if one is willing and able to face the simple facts. Whether I wrote all that out or not is of no issue in terms of the simplicity of it. So how can the global economy expand after the 2006 peak in oil production? It must contract. Economic activity drops as fuel supply drops. If there's less oil, that's actually a chart of conventional oil or crude oil, but if there's less oil produced, then there's less oil refined, and there's less oil available to use. If there's less oil used, and if there's less energy used overall, then that means less economic activity, less driving, less flying, less electricity, all that stuff. Less manufacturing, right? Or less industrial manufacturing. So economic activity drops as fuel supply drops. Things like currency inflation or credit deflation are secondary financial measures relative to a primary tangible economic issue like an empty fuel tank in your car. Having lots of cash or credit, but being out of gas in the middle of a desolate highway did not make a fool into a genius. The cash and credit are not as relevant as the gas. Primary functional economic tangibles like gasoline and food are the things that we value having currency to access. No one cares much about currency or even something like gold when they're starving, right? Or if somebody else comes by, you're on the middle of a desolate highway, right? Desolate highway, and someone comes by and you tell them you're out of gas, and they say, well, I've got some extra gas here in this little container, like my little 2.5 or 5 gallon container. But what you really need is some paper with little ink on it. Or here, I'll give you my credit card. Or here, I'll give you a chunk of gold. But I'm gonna keep my little, 2.5 gallons of gas. I might run out. There's not a lot of gas stations around here, so sorry about that. So no one cares much about currency or gold when they're starving, right? When they need gasoline, they're going to use gold or currency because it's useful to get something else. The thing itself of gold or currency aren't inherently that functional. Gasoline, that's functional. Food, that can be functional. So it was the spiking of fuel prices by 2007 that were accompanied by the steep decline of global stock prices in 2008. There's some chart of that below. After stocks began to plummet, fuel prices did too eventually. So that's all as I predicted. They were rising together. Then stocks fell first because oil and gasoline prices got so much that it started to crimp or pinch the U.S. economy and other economies throughout the industrialized world. So further, real estate borrowing had predictably diminished considerably as well, again related to high fuel prices in part. So real estate prices predictably declined dramatically, which resulted in financial trouble for many financial institutions such as Fannie Mae, AIG, and Washington Mutual, as I specifically predicted in a video that has been online since 2006. I can send a link to that to those interested. I don't specify individual companies to my recollection, but I talk about just financial institutions, banks, such as Washington Mutual. Just I don't specifically name it. Anyway, as oil prices in red spiked into 2008, the financial sector and other sectors of the U.S. stock market declined along with global stock markets. I don't know if the financial sector actually dropped first. Off the top of my head, I don't recall. Anyway, after oil prices rose up to near $150 a barrel, they then plunged over 70% in about half a year. And at that time, the stocks globally and in the U.S., including the U.S. financial sector, were still going down. But once oil bottomed in late 2008, right after that, the fuel prices had gotten low enough that stock prices began to recover. The economic activity within the U.S. and Europe and Japan and so on began to recover. Not tremendously, but some. In that chart of the financial sector, you see it didn't recover really much at all, but in other sectors it recovered more. Once fuel prices fell there in late 2008, the global stock market began to recover. However, gasoline prices in the U.S. recently approached their 2008 highs again, in red in the chart below there. And most people know gasoline prices have gone back up way over $3 a gallon. In 2007, stocks peaked while gasoline and silver continued to rise. Then silver peaked in early 2008 next, and then gasoline in late or summer 2008. Doesn't that imply that rising fuel prices may have been the cause of the decline in prices of stocks in the U.S. and globally, and even of silver? Or maybe it was high silver prices that brought down everything, right? Wink. When gasoline prices in the U.S. reached a high enough level in April to reverse the spending behavior of the U.S. economy, dropping demand enough to reduce purchases and bring down gasoline prices. That's not a good sentence. Anyway, when gasoline prices in the U.S. reached a high enough level in April to reverse the spending of behavior of the U.S. economy, that dropped demand enough to reduce purchases and then bring down gas prices. So there's nothing contradictory about the fact that gas prices fell. That timing simply, they fell enough to have recovery start, and they rose enough to break the rebound. In the very beginning of March 2009, I predicted the rebound in U.S. stocks very explicitly. I established some targets of like sentiment and confidence and optimism that would mark the high enough level of irrational exuberance, at which point I would expect a decline again, and that point has been reached and surpassed in terms of naive optimism and so forth. Evidenced by people saying things like, "Wow, now that the S&P has announced that the U.S. Treasury was already not as safe an investment as we thought. Now that they've announced it and it's publicly acknowledged, then people respond." Well, that's actually a little bit weird. It just means that's when it makes the news. Once it makes the news and people respond, well, that doesn't necessarily alter the solvency of the U.S. Treasury. Like it was bad like Friday. It's not worse Monday than Friday. They just made the announcement over the weekend. People react, but that doesn't necessarily change the thing that's been reported. It's like, you get a news report that someone was born. Well, that doesn't, they weren't born because of the news report. The news report happened because they were born. So getting the news of it doesn't change the underlying reality. The situation in the U.S. was already extreme naive optimism, and people are starting to recognize, oh, I underestimated risk. Yep. So that reduction in a fundamental behavior of buying gasoline within the U.S. economy also brought down the prices of the U.S. stock market. Really it wasn't the reduction in spending for gasoline. It was that people were spending on gasoline instead of things like investing in the stock market. They were pulling funds out of the stock market, perhaps to spend on unexpectedly high fuel prices. So those three things, the gasoline prices, stock prices in the U.S. and silver all peaked on exactly the same day recently, April 29, 2011, this year. Close up of that is shown below, but no one could have predicted that rising gasoline prices would have in any way affected the U.S. economy or spending habits or stock prices or even silver prices, right? Wink, wink, wink. Rising fuel prices could not really have any effect on popping bubbles of speculative mania, would they? Wink, wink, wink. Then again, maybe the cause was President Bush or President Obama, not gasoline prices. Or maybe they are personally responsible for gasoline prices, like maybe whether the prices of gasoline fall or rise is totally dependent on the choices of exactly one person. But why did the Japanese economy slow down in 1989? Why did the European economies begin to slow in 1999? Did $11 gallons of diesel in the UK in 2008 have any effect on the spending behaviors and economic activities of businesses and consumers within the UK? Possible? Yes. Predictable? Yes. So what's coming next? More selling of stocks and real estate. I've been warning of that since before 2004. I knew that the speculative bubbles would not last forever and were nearing their extremes. Real estate began peaking in 2005 in places like Phoenix and soon extended most of the US and much of Europe, etc. Stocks began peaking in the U.S. in 2007, at least for most sectors, excluding high tech, which peaked several years prior. There is a chart of a stock sector that rose more than 1,600% last decade, so that was an exception. That is the U.S. stock sector, HUI. However, the mining stocks of HUI are part of the same economy too. They are subject to decline, as they did in 2007, 2008, as the rest of the U.S. stock market declined. And they actually peaked in early April this year, prior to the 29th, when other stuff like gasoline, silver, and the U.S. stock market as a whole all peaked on that same day, April 29th. So HUI dipped down early. That kind of might have given a warning as it diverged from the mainstream bulk of the broad U.S. stock market. Anyway, what has done well lately in these last several weeks? Well, here are a few examples of gains approaching 100% in the last 10 days. ERY is the black line, TZA is the tan line, or I don't know, gold colored, whatever. Those are up near 90% for the last 10 days. What else did well lately? I sold a put option for $1.07 today that closed Friday at 17 cents. That change, up over 400%, is a pretty decent increase for a single day, right? But remember, the mass media and massive bureaucracies may indicate that there is no such thing as predictability, or at least not in certain instances. Even notice that as you are reading this sentence or listening to this speaking, there's absolutely no way to predict that the sentence is going to end with a punctuation mark. Is there? Or a pause? Crazy stuff that people would predict. Anything. Nothing's predictable. No one could have predicted any of this. The future is completely unrelated to the past. Not just your personal future, but even the future of how this sentence is going to end. Nature does not have any patterns in it. Wink, wink, wink. And that, as always, is entirely the fault of the U.S. President, or the Federal Reserve, or OPEC, or this sentence. So how are we going to fix the problem of nature not having any predictable patterns in it? First, let's blame someone else, because that has always worked marvelously in the past, right? Then let's wait for the person that we blame to save us from them. Finally, let's complain about how waiting for them to save us from them is still not working, again, as usual, as always. Just do not adjust. After all, adjusting could affect your actual results. And no one is interested in financial security or economic prosperity, because that would be evil and shameful and of no functional relevance whatsoever. So is any of this fooling you? Keep in mind that sometimes translations can shift the implication of a message. If someone were to suggest that proudly foolish naivety about financial speculative bubbles was a major risk, deserving great caution, do you think that message might be translated like this? Proud attachment to ideals about wealth is dangerous, is risky. Or even, the love of money is the root of all evil. It's not ignorance that is most risky. It is believing that something is so when in fact it is not. from an emotional or irrational attachment to false presumptions. What predictably arise? Things like blame, anger, grief, agonizing, and proud argumentativeness, and shame. They all arise. Learn that, either the easy way or the hard way, but learn it fast. I think, to quote Isaiah and Jesus, in vain they neglect what's actually going on for focusing instead on the traditions of people, like traditional beliefs and institutional, cultural ideals and sacred cows. That's a pretty broad translation of Mark 7:7, and I don't remember what exact passage in Isaiah, but anyway, in vain, some people worship what should be according to tradition rather than what actually is the way that nature works, that God creates things, if you want to use that terminology. So, by the way, yesterday at the close of trading, Monday, 8/8/2011, I purchased some call options on the U.S. stock market. Those positions rise in value when stock prices rise. After one of the biggest down days in U.S. stocks in decades, I understood that the panic of the masses after the weekend downgrade of U.S. debt, after the news was announced, could be a short-term buy signal for U.S. stocks. So, after stock futures dropped another 2% in overnight trading, they then reversed 4% so far and are again pushing toward an open of more than 2% up from yesterday's close. That should produce overnight gains of well over 100% for those instruments, those call options. Purchased it right before close of trading yesterday. Actually, it was right after close, I think. All right, right near close of trading yesterday. Close of regular trading. There's like 15 to 30 minutes right after regular trading. There's still a lot of activity available. All right, so that one is called First Harmony, Then Prosperity. Hope you like it.